Thank you. Okay, so the first question here is, would you like to suggest at all that people consider switching any IRA holdings to Roth at this time?
That is a wonderful question. Uh, I think it is a very opportune time to, I'm just sorry, I apologize. I'm looking at the technology here. Danielle, you can see me again, correct? Perfect. Uh, it is an opportune time, I think, when there are dips to move from a traditional IRA to a Roth. So in your personal accounts, absolutely make that switch. You know, I it you want to minimize your taxes. So if you have a whole bunch of long-term holdings, you don't have to sell any of it. Let's say it's with Schwab or wherever it is. You literally just fill out the form. You have to pay tax. So let me actually take a step back. It's a great question. Um, it's not like personal finance here. This isn't what I do, but I know so I know how powerful this is. So if you have an IRA, you pay taxes at the end, or 401k that you could roll into an IRA, you pay taxes when you pull the money out. If you have a Roth IRA, you pay taxes. You pay taxes when it goes in, but you can always roll your money from an IRA to a Roth IRA, and ideally, you'll get your money in a Roth IRA because as it compounds and compounds over time, when you take it out, it's now totally tax-free. There's no taxes at all in a Roth IRA. There's other benefits as well. You can pass on to heirs. It can be treated sort of like a little bit of a trust. So yeah, if you can get your money into a Roth, you want your money into a Roth. So when do you want to move your money into a Roth? You want to move it there when your balances are as low as possible. So if you see a dip in the market, you take that opportunity, you roll that into a Roth. Now you only pay taxes on the capital gains you've made in your IRA since you contributed to your original IRA. You make that move over to the Roth. You keep all your same holdings. Now that rebound occurs and it's all now tax-free. So that's a really insightful question.
Okay, so questions are rolling in. Thanks, you guys. Keep sending them in. I'm collecting them. So the next question is, what effect would negative interest rates have on our strategies in this portfolio?
Okay, well, that's an excellent question. I will. So the macro environment is first of all, the real answer is I don't know and nobody knows. So and it's like a totally unknowable situation. And by the way, because the Fed, Powell doesn't know. So, and that's why they're not going to go negative in the US. It would be a very, I think, extreme step to see rates going negative in the US. I understand they're negative in Europe and elsewhere, but we are trying to avoid that. That's why there's all this stimulus heading out in terms of spending and buying. So I don't think that it's something that we have to worry about. The macro environment is very hard to predict because there are so many factors. I often tell people there's two types of people in the world. There's the people that know that they don't know, and there's the people that don't know they don't know. And this is definitely one of those factors. Adam Smith never even talked about this. I mean, consider who in their right mind would lend money to someone to get less of it later. It doesn't even feel rational, as many of you will understand. So it's so what I will add to that is, how will it affect Daily Journal? I don't really know, but it's not really going to affect them in the same way that it might affect a company that is more dependent on rates. So it might have a major impact and a negative impact economically at the macro level, but we're looking very bottom up at these firms. So it's not something that keeps me up at night, and I'm actually very confident that we are not going to be pursuing any sort of negative rate strategies in the US. That's something that we are actively trying to avoid.
Okay, so this next question is about Daily Journal. And the questioner is asking, what percent allocation do you have to the Daily Journal in the portfolio, and particularly over the last year, what's the return?
Okay, great question. So again, we have a concentrated portfolio. Uh, I we have just right around 20% of the portfolio is Daily Journal, and so what is the return of Daily Journal over the last? Well, as I said, over the last 6 months. So in the last year or so, the price has basically gone above 300 two times. I think it went below 200 two times. I talked at this exact meeting about Daily Journal last year. And then over the next month, I think it dipped down below 200. And I had like more messages than ever about all these people who were buying Daily Journal, which I was actually pleased about. So the return, I guess probably it's up 10 or 20%. I don't know exactly what I'm really not watching the prices very, on a daily basis, but, at the beginning of the year, it was just under 300. Again, it dipped down below 200, and I think it's probably back in the 290s or so, roughly. And again, it's probably worth 1,000. It's 20% of the portfolio. As it dips, it becomes less portfolio. As it grows, it becomes more. As we raise capital, it becomes less. And then if we buy more, it increases. So it's a little bit of a fluid situation, but it is typically, right now, it's right around 20%.
Okay, great. So this one's from Vishal. What are the pros and cons of buying shares versus buying puts on the shares?
Okay, great question. Great question for a whole number of reasons. So first of all, just a small nuance here is that what you mean probably is selling puts. So buying puts would give you protection. It would allow you to sell your shares to someone else if there was a decline. But selling puts is where somebody will put them to you. So there are several benefits, and they do get quite subtle, but the obvious benefit, and I should point out, this is not the way that these products are used typically. Okay, if you went around, first of all, not many people are using these products, not many funds are using these products, but those that are not using them in this nature. They're using them either as a form of protection, or they have some complex trading strategy. They're typically used very short term. The prices are extremely volatile, but it is incredibly rare to use the sale of a put as a tool to deliver the equity. And, as Peter Kaufman says, where there's mystery, there's margin, and there's just not a lot of people operating in this way. And so you end up with a lot of mispricings because people are doing different things with them. The major benefit is that, just like the slide at the beginning, the Berkshire example, or any other example you'd look at, when you want to buy the stock, you can either go to the New York Stock Exchange and buy it, or you can sell a put through the Chicago Board of Exchange. And when you do that, you pick up a premium, and it reduces the price that you're paying for the security initially. And when you reduce that price, it actually increases your return substantially over the long term. So in the example where you had a $100 price stock, by the way, if it was 100 for a number of years, a put premium might be $1 or $2. But the fact that it went from 200 to 100 means that you can now get 25. And so somebody's willing to pay you 25. You've now reduced your investment, the denominator of your investment, to $75 from 100. And so if you ultimately sell at 150, instead of making 50% by going from 100 to 150, you now make 100% because you've gone from 75, your reduced price, to 150. And so at the highest, most important and obvious level, you're just getting a discount to the price, to the retail stock exchange price. On a more subtle one of the more subtle advantages is the sort of psychological advantage. So people talk all the time about how they're trying to look, this group needs to know, I mean, you can't time the market. Okay. If you try to sell at the top and buy at the bottom, it just doesn't work. We're all human beings. We all suffer from the same biases, and worse, even if you do top tick the market, and I mean, it's very hard to get back in at the right time. And then as soon as the market starts rising again, I mean, many of you probably had experiences with this, and probably some of you did a great job, but back in March, as markets started rising again, if you ended up in cash because you sold out intelligently, it became very hard to put that back in because you always want yesterday's prices. You don't want to overpay, and prices are on the rise. So by selling these puts, what it actually does is it sort of enforces a very rational mindset where you sit back, do your calculations, understand the value of the business, determine the price that you want to buy it, set your limit orders, you sell that product to the counterpart, and you're in and you're invested. And so if it's a little off the bottom, you get a premium, so it brings you back down. So there's these psychological advantages I find that maybe don't force you to focus so much on a absolute bottom tick of some security price or top tick of some security price. And by the way, if any of you are interested in doing this, I recommend just go out, each put is 100 shares, and go out and take your personal account and go out 1 year and write one on some security you like to own and watch it play out, because you will just learn a lot from that experience.
Okay, we've gotten a few more questions about puts, so I'm going to actually just put them together. So first of all, do you sell on the money put contracts? Why or why not? And secondly, what new companies are you considering to be buying or selling puts at?
Okay, very great question. So you can sell puts. I know there's a wide range of people here. So basically, when you're selling a put, you determine the price that you're going to buy the stock, and you could choose a price that's above the current market price. You could choose it at the current market price, which is called at the money, or you could choose to buy the shares below the current market price, which is out of the money. And in many cases, so it sort of depends on how big your cash pile is and how much you're trying to put to work. Oftentimes we create a matrix where we'll sell above the money, at the money, and below the money contracts at different strikes. We'll sell them also expiring at different dates. So what oftentimes happens is we buy some of them and we don't buy others. And actually the ultimate outcome, because we'll pick up premiums on some that we didn't buy and others that we did, if you sort of look at it from that perspective, it just brings the price way, way down. But it really comes down, the most important thing to be thinking about is, what am I willing to pay for this security? What's the value? What's it selling for? And at that point, you can write a contract. So if you're saying to yourself, for example, I would love to buy, name a company, I would love to buy Disney, but I would only pay $100 for it. So I'm going to wait for the next 6 months with a whole bunch of cash. And I'm only going to buy it if it goes to 100. That's an exceptional opportunity to go out and sell a put to somebody. You sell a put for 100, they pay you $10. Now you're going to buy it for 90. The price today is 130. If it happens to go down to 100, which is when you wanted to buy it, they'll force it to you. By the way, if you didn't sell the put and it dropped to 100, you might get greedy and say, oh, now I'll wait till 90. And then you miss the opportunity that you were waiting for, which is why you don't want to be timing markets. So we will sell above, at, and below, oftentimes on the same securities. So the next question is, what are we looking at? So first of all, we're always looking at a lot of things. We're always looking for new ideas. And we have a number of channels that we're reviewing always to find those. But keep in mind, we don't need very many new ideas at all. I mean, we have a fully invested portfolio. There's not anything there's not any pressing need to go out and find a new company to invest in. But there are a lot of, I think, great opportunities out there, and some of them are beaten down. So there's two. I bucket things in two categories. There's sort of the Graham investments that we look at, and those are, many of you might have heard the idea of this cigar butt company. Basically, those would be companies that are not really growing. They're sort of trading at a discount to their intrinsic value, and you get them at a big discount. So you buy them at 50%, maybe you get a pop, and then you sell that, and then you move on to the next one. And then there's the Phil Fisher companies out there. And Phil Fisher is more of the long-term compounding firms where you still can buy them at a discount, but they just keep growing and growing and growing. And there's all sorts of reasons, from tax advantages to avoiding mistakes, that Fisher type companies are greatly preferred. So, we're looking for Fisher type companies. If you're thinking about Fisher type companies, you get to think much longer term, in my view. You go through the crisis. And so, if you're asking because you want to look yourself, you might start looking in some of the beaten down industries. I mean, there's all sorts of really beaten down sectors, from travel sectors and entertainment sectors. There's financials are beaten down. I mean, things are really have been hit hard, and so you can find a lot of great stuff in that area. But for us personally, we're not really, we've added kind of one company. You'll probably see it in the audit and things at the end of the year, but other than that, we're not really adding anything at the moment. We're compounding our capital. Our capital is just, it's going to compound.
So we've been getting a bunch of comments and questions, very detailed about puts, but I'm going to move on because that could take up a lot of time, and I would suggest, maybe we can get to them at the end, but I would suggest maybe talking separately with Matthew afterwards. And let's go to some of the questions more about the overall portfolio. So we got a couple asking how the portfolio is doing overall. First of all, say over the last 5 years, how has the portfolio grown in cash value? Has the net number of partners grown in the last 5 years? And then also in the last year, how has it been doing?
Sure, absolutely. We have been raising a bit of capital, specifically over the last 3 months. We've started raising some capital. We've had a lot of interest because obviously we're in a value fund. There's a lot of volatility. Our strategies are going to execute quite well. And for anybody who's really interested in an in-depth discussion on all this, I strongly encourage you, if you have not, go and look at the annual reports. They're on our website, petersonfunds.com. I write they're really extensive, and we kind of talk about all of this type of information. So over the last 5 years, we've kind of been flattish and volatile. And it's not that fun for me to be flat and volatile, but we own incredible businesses. So it's not that big of a burden. I mean, I prefer to always be up and to the right. That's not always possible. Value in itself, by the way, and this is just factual details, but the value industry has been really flat or even down for about 5 years. So if you look back over maybe a 75 or 100-year time horizon, and really 75, because there wasn't a whole lot of value idea back then, but value has tended to outperform growth and all of these other sectors on like a 10-year rolling basis in all of them, except for this past period in time. So, what we have now is I don't want to comment too much. We're kind of living in an environment where there's this like narrative approach to a lot of these companies. So there's a lot of similarities to things that I was seeing back in sort of the late 90s, where there's a really good narrative, a really good story around a new business, and it tends to get pretty large. And it might not have all of the fundamentals in place, but there's enough people and enough time has passed that people have sort of forgotten that jump on board. And so it's a little bit of a self-fulfilling prophecy for a time, for a period of time. And then we'll kind of see what happens. But, you know, value is based on what something's worth. And that value is based on a discount of all of the future earnings of the business that's going to be paid out to the owners. So ultimately, the price will be reflected by the value. So so our holdings are growing in value. I'll give you a really, again, I don't want to go through like our whole book, but Dondo Holdings is a totally great example. So in 2015, we had a 40% position in Dondo, which is such an incredible, diversified, their firm. It's actually gives us access to this. So it's run by Manish Pabrai. It's a very special thing that we were able to buy 3% of this firm. It's actually a private firm, so we had to do a private agreement. And we bought 3% of the company. And inside of the company, which is, has a very low price. It's like $30 million in book value. And we hold it at book value because that's what our accountants require us to hold it at. There's a $100 million hedge fund focused on India. So Manish is running this hedge fund inside of Dondo. And inside of our fund, we own 3% of his fund. We're not invested in his fund. We own his fund. It's such a big deal. And the book value of a hedge fund is basically zero. I mean, there's maybe a computer or something. So we hold Manish's hedge fund in our hedge fund at zero. And I mean, we don't hold that at zero. We actually bought it for $10 a share. And we've been receiving distributions, and it still makes up a 15% position in our portfolio, but it's been totally flat. It's actually down. It's down probably 5% over 5 years or so. And it's very exciting that we own it. And it doesn't bother me. I hope it shouldn't bother you. If you really, really understand what's going on, it won't bother you because we have this position that is basically worth so much more than we're holding it for on our books. And at some point, this Indian-focused hedge fund is going to pay us a huge payout, and it'll lift the whole portfolio or lift the book value. So over the last 5 years, pretty flat. A lot of value has been flat. I want it to grow, but it's been flat. I think we're in a new environment. The last 5 years has been a tough environment. And was there a third question? We've been picking up some new LPs. I will actually make one quick comment. I'm actually so pleased because I have so many friends that are in the fund management business. And, we have about 40 or so LPs, limited partners. When we went down during March or for, H1, a lot of other funds started receiving redemptions. A lot of them got, actually a few of them closed. And that's awful. And it's totally the wrong time, but you can't do anything about it. We actually, initially we received only one request for a redemption. We had one LP that had a family member that was overseas and needed to get a little bit of cash. We made that happen very quickly, sent over a few $1,000s. And then we have one outstanding request for redemption. It's so pleasing to me that our LPs, have these long-term views.
So following up on that, another question is about the coronavirus situation, which you haven't really talked about that much. How do you see that affecting the portfolio overall? Are any holdings disproportionately affected by the virus, by the lockdowns? And the questioner is asking maybe perhaps the offshore positions in particular.
Yeah. Okay. So that's excellent questions. So I run the risk here of sounding too optimistic, but I am, I think, very rationally optimistic about the outcome. But I also tend to have a long-term mindset. I I think we are right now in the most incredible opportunity of maybe this generation to be buying and putting money to work in the markets. This is the opportunity, as I tried to explain with those slides. And I was just, look, I'll just throw out a few data points. And I know that a lot of this is going to sound very controversial. But look, the other day, some of you will be familiar with Nate Silver, the statistician. He runs 538.com, and Fauci was on 538.com giving this whole explanation on, how he expects things to proceed. And he's basically talking about how the number of vaccines that are in their final stages of testing, and that he's also very optimistic that we're going to find a cure, and maybe it'll have 70% efficacy and only 70% of the population will even be willing to accept the vaccine, but that will be enough. And he also went on to explain that there are several businesses that we are becoming more familiar with in the last few days that are going to start producing these vaccines prior to FDA approval. So, we're basically expecting, and he expects one or multiple vaccines before year end. And he expects prior to FDA approval, we will have tens of millions of vaccines available. And that will, of course, they'll first be available for the people on the front lines. And, however that's rolled out will be a discussion. But ultimately, I think people are very social creatures and they want to get back to some form of normalcy. I mean, most of us are probably in some form of self-quarantine at the moment. And people want to get out. I see people, when we try, the nation, a lot of states try to open early, and what you saw is people crowding at beaches and going out to restaurants and getting together with their friends. And of course that caused a problem. But the point is, people we're social creatures. We want to be out. So once you get a vaccine and some of these things get under control, I think we'll start to get to a new normal pretty quickly. Further, I see, this is so different. So I've been investing now for over 2 decades professionally, and this is like the third major crisis that I've been through. There's a lot of similarities, but there's also some differences. And one of them is the government response. And I know nobody has a crystal ball, so you have to use probabilistic thinking when you're considering any of this. But one of the strong possibilities is that let's just look comparably from the financial crisis, 2009. In 2009, the unprecedented bailout. Okay, I was consulting for Goldman in Wall Street and London doing risk management work, and there was this announcement, the unprecedented bailout. And you probably remember it was like Hank Paulson was like on his knees begging Bush, and they issued $700 billion. And that money went mostly to bank reserves. What they did this time is they issued $8 trillion. So this is like such a different dynamic. And they did it differently as well. Instead of putting into bank reserves, it mostly went into cash, into like consumer pockets. So they did the PPP loans, and then they did the bailout, of course, and they did the stimulus package, and they increased all the unemployment benefits. And so that's why you have these money markets sitting at banks with $5 trillion earning zero. So if we get to a point where there's a vaccine, which I sort of anticipate, maybe I don't want to put a time frame on it, but vaccines are going to be available and FDA approved by the end of this year, and then maybe they roll out in the 100 millions next quarter, which is what Fauci was explaining, or not next quarter, sorry, for Q1 2021. Well, now you've got $5 trillion sitting in money markets. So where's that going to go? That's either going to go into consumer purchases, or it's going to ultimately make its way into investments. And both of them, I think, will benefit the equity markets, surprisingly, because consumer purchases are going to, earnings have been hit so hard because nobody's spending, because nobody has anywhere to go. Now people go out and start pursuing their lives, and suddenly earnings start surprising to the upside. Now, when you get all these earnings surprises to the upside, that drives the equity markets up. And there starts to become this fear of missing out. So anybody sitting around with cash earning zero starts to wonder if maybe they should be putting their money to work. And so I think, look, the coronavirus certainly hit us. We have a basket of some financials, right? We have one OEM that got hit particularly hard, and and that's it will actually come back a little bit, but and the environment's certainly changed. We've all seen what's happened with the technology space. The positions overseas are very interesting. You've seen a number of, there's actually a stronger interest now for further diversification. And a lot of people are talking about strong dollar. A lot of the news and things that you'd see would talk about the value of having an emerging market sort of position. So as many of you know, we built Thales. We are an owner of Thales. And Thales is an exceptional position. We built this capital pipe that goes into Turkey, and we built a basket of securities out in Turkey. It's 5 or 6% of the portfolio. We call it one position, but it's really 13 holdings. And they're just incredible. It's like Coca-Cola bottling company of the Middle East selling for 6 times earnings when it sells for 22 times earnings everywhere else in the world. And is Coca-Cola in the Middle East particularly impacted by coronavirus? There's probably a little bit of decline in earnings because people aren't out at restaurants as much. But if you just can look out, I think by the end of 2021, and certainly by into 2022, people will look back at this period right now as with envy. They'll just say these prices were so incredible, and it will become so obvious that they were so incredible. And so you have to look through this uncertainty and just get comfortable with the fact that there will be volatility, but we own great companies. And so, I guess that's a lot of that was sort of a macro view, but I do think, and by the way, I will throw out, since I am talking macro views, which we have no crystal ball and I have no ability to predict it any better than anybody else. There's something else that might happen. And I kind of think that the probability of this happening is growing. I think that it's growing. I've been talking about it for a while and it hasn't happened. So I've been wrong. I mean, if you're too early, you look wrong. So, but we've been missing inflation. And we've been missing inflation for so long that people have said, well, I guess we have the model wrong. I guess we don't get inflation when we print money. And I don't think that's the case. I think we have the model right. I think we get inflation when we print money. And so we just printed 8 trillion and mailed it out to everybody. Everyone talks like we're having deflation. And I think the surprise will be when we start getting a little bit of inflation. And I don't think it'll be hyperinflation, but I expect Powell in all of his statements, he'll hold his statements true. We have, high unemployment right now. It's still, I think it hit 20, but now it's probably at 10. And the focus from the Fed will be on the unemployment figures. So they will keep interest rates low despite a bit of inflation, and or we, I guess, could call it reflation. So even if it starts ticking up 3%, 4% above their 2% target, I bet they keep interest rates low, which means if you're sitting in your money market account, you're earning nothing and inflation's 4%. So, people think that cash is safe. Cash is trash. Cash will just be eroded and eroded and eroded. You lose purchasing power year after year, and people will start to recognize that, and they'll realize they have to put their money to work somewhere. And what are their options? Bond market is interest rates are zero. Corporate bonds, you get a little, risk premium. So you're making 2 or 3% in some bond portfolio, which also has a lot of risk because as rates do go up, that comes down. Or you have the equity market. And so I think there's a lot of cash sitting around, it's a very fearful time. Corona is a very big problem, clearly. One death is too many. It's a terrible environment, but we will get through this. I mean, we've gotten through wars and we've been through pandemics before. So we will get through this. And from the other side, we'll look back at this and recognize the opportunity that we're in right now.
Thanks for addressing the macro. We've gotten a few comments that was very interesting. So to stay, I've got two more questions. We're coming up on about an hour and a half here, just to mark the time. Again, more sort of on a larger view, how are algorithms, AI, how is that changing active investing and particularly market efficiency? And how is that changing any way that you are using those tools in your process?
Yeah, that's a really thoughtful question. There's a few things that are taking place, and some of it is AI. And I'm by no means an expert in artificial intelligence, but one thing that's certainly happened that many of you will be aware of is there's been this big push toward indexing. And indexing over the last few years, it's actually gotten so extreme that people have started to think like indexing is better than actually knowing what you own, which is sort of strange way to think about it. So an index would be like owning the S&P 500. You own actually 500 companies, and some of them are overvalued and some of them are undervalued. And it's actually generally, human biases and costs and things cause a lot of people to underperform. But actually, so a lot of people are defaulting to the sort of index funds. Now there's these other funds that are popping up, and they're sort of driven by AI. You can have algorithmic traders. Look, I think the long-term position that we will probably be in is to use AI as a support system and work collectively with AI to analyze large data sets and sort of get a better grasp of a business. So look, I think that the jury's out on AI and funds that are driven by AI at this point, but AI is a very powerful force. So when you are looking at a very concentrated portfolio of 10 companies, and you can really have a grasp of those firms, there may be ways to use AI as a support. And if people think that I should be applying AI in certain ways, I'd be happy to hear your suggestions. But I don't think AI would necessarily be a strong competitor today. That said, at some point, AI won at Jeopardy and chess, and then now Go. And, at some point, AI will be very capable. I've seen AI outperform traders, and, it's improving very quickly. So at some point, AI will be a very valuable thing. And I think, almost like the Watson and how Watson sort of assists with doctors, but doesn't perform the actual surgeries. I think that's sort of how I envision AI working in the financial space. And algorithmic traders and things like that can work well for a while. They can have issues as well. I'm really not a total expert on AI, but I understand that it's very relevant and coming into the industry pretty quickly.
So to come back to one of the main portfolio companies, Daily Journal again, the question is, are you concerned about the illiquidity of Daily Journal at all? And how are you able to purchase meaningful shares with such a low daily trading volume and big spreads in the bid and the ask?
That is an excellent question. So the liquidity doesn't bother me at all because we're not trading the shares. But it is extremely illiquid. Okay, one share costs $300, and there are days, I think you can go check the volume, but there are days where just a handful trade. But there are also days where block trades. So what I you can go out and buy shares. I mean, look, you can go out and buy shares, but what I do is I set limit orders if I'm going to buy shares. So, and then you'll end up with somebody selling inevitably, and you'll just be, there's always counterparts, so you'll pick up their shares. So the illiquidity doesn't bother me. It took us about 6 months to build $1 million position. So you can do it. It doesn't have to take a lot of your time. If you do want to buy Daily Journal independently, just go out and set a limit order, and somebody will come in and eventually sell you their shares. So I encourage it. Go out and buy Daily Journal. We'll be partners.
Okay, should we make this the last question, or are you up for a couple more?
Yeah, I'm happy to keep going. There's great questions out there. Anybody can drop off if they need to. There's no, nobody needs to stick around. It's all voluntary in the first place. So I'm happy to answer questions if people have them.
Okay, so I'm going to ask one more sort of broad question, and then we'll get to those questions about the puts.
Okay.
So the broader question is that the portfolio is primarily invested in equities, but can you talk about other asset classes like crypto or bonds or gold? Particularly, people are very interested in these days. Should we be thinking about that? Are you thinking about that?
Yeah, that's a really good question. I do think, so we are primarily invested in equities, but we really are invested in the asset class that grows the fastest. So in fact, Jeremy Siegel, who's a professor at Wharton, put together about 200 years of data. That's a great question. Let me see if I have in the appendix here, I'm going to see if I can pull up a little slide. I'm going to share the screen again for a moment and try to bring us to, here's a slide that I can share. So this is, oh, my apologies. I thought I was going to go right there. So this is, can you see this, Danielle?
Yes.
Perfect. So this is a diagram that was put together by Jeremy Siegel in his book, Stocks for the Long Run. He's Wharton's an excellent financial school, probably within the top 3 probably in the world. And he's the chair there. He put together 200 years of data and basically analyzed it extensively in his book, Stocks for the Long Run. And you can see here, if you put $1 into all these different asset classes in 1800, what's going to happen? So if you put $1 in dollars, it turned into 6 cents. And this is after inflation, right? So inflation just took out all your money. So the most risky asset is cash. Gold over 200 years went to $2. So it went from 1 to 2. T-bills went to $300 and bonds went to $1,000. So we went from $1 to $1,000 with bonds. And then stocks went to $755,000. So it's like not even comparable, right? This is on a log scale. Otherwise the stocks would be off this chart literally. And so this is mainly the reason. I mean, we're focused on the long run. I'm not focused on 200 years, but all these dips and things along the way, I mean, you can probably sort of see here, oh yeah, there was a Great Depression in there. It kind of lasted for certainly from 2009 to 19, or from 29 to 1933. You can see all these dips, but it's actually pretty remarkable. And so what he found is that over in like 10-year periods, if you look at these rolling averages, the rate of return is 6.8% plus inflation. So after inflation, you get about 6.8%. And that's been remarkably stable over many, many years. So, and if you think about it these are stocks or businesses. So businesses are designed, I'll stop sharing this now. I just kind of want to throw that out. But businesses are designed to earn profit. That's the whole point. And you have ones that make a lot of profit, and you have others that don't make profit. But that's literally the function of a corporation. So that's kind of why you'd want your money there. If you bought a bunch of gold, and look, you want some diversification, great, go buy some gold. We don't own gold. I saw that Buffett bought a little gold, which is interesting. But you don't really, gold doesn't actually make money. It just sort of sits there. So you can have gold, and then the environment around will speculate on the price of that gold. And maybe maybe the dollar is very strong. The dollar is very strong in this world. If anybody's gone overseas in the last couple of years, it's like, it's great. But maybe that adjusts down a little bit, and then maybe gold goes up against the dollar. And so, but that's still speculating. It's not like gold is producing more gold. Whereas if a company's compounding their capital and then reinvesting that, that capital is, those dollars are making dollars, and then those dollars are making dollars. And that's really where you want to be. Bonds, I will share with you all. I strongly encourage, especially even the ones that are, older. It's like bonds are, we've had a 40-year run where bonds have done really well. And so it's it's like brainwashed 2 generations. Interest rates have just come down since the 80s. We have hit 0. Okay. So, and as long, bond over time, interest rates will rise. And when interest rates rise, bond prices fall. So we are in an environment now where you basically top tick your bonds. You're at the top, so sell them. I think bonds are a very unnecessary risk to be having in your portfolio right now, because if rates do jump, those bonds start to fall, especially any sort of longer term bonds. Also things, municipalities and things that issue munis. So people like them for the tax benefits, but they forget that if a municipality has trouble, they won't pay their bonds. So there's actually risk of default in bonds as well. So bonds are a little, I don't think bonds are a wise place to have long-term capital right now. I think that inflation, by the way, if you look at bonds, our treasuries are pay 0 to 1%, and the Fed's target inflation is 2%. It's sort of like cash; you lose money every year in terms of purchasing power. And then finally, cryptocurrency. Look, I'm not totally opposed to diversification. The value community in general sort of shuns cryptocurrency because it's a speculative asset without any real tangible value. But maybe it becomes something a little bit in the future. Maybe it becomes more something that you could transact in. So we don't own it. I don't think we would ever own it in the portfolio for any reason. But if you want to own a little bit, sure. It's kind of like maybe going to Vegas or something. You just go buy some Ethereum and see what happens, and that's fine. But I don't think of owning cryptocurrency as an investment, and that's why we're primarily in equities.
All right, thank you. So I've got 3 really interesting questions about puts here. And some of them are a little long, so I'm going to try to sort of shorten them up so that we can get through them. So first of all, this one question says, upside is limited to the premium collected when you sell the put contract. So the question is really, how do you hedge the upside if the stock runs up? And would you maybe buy a call option to lock in a further gain?
Yeah, that's a great question. And we do that. So it just gets a little, I think, beyond the scope of like a mass group discussion sometimes. But yes, there's been a number of times where we will use, in fact, we have calls on Berkshire Hathaway that go out 2 years with a strike of $170. And so we will use put premiums to buy the call. So it actually becomes like a free a free option. When I do, so first of all, I will also add, I much prefer money coming in. Okay, there tends to be a systematic advantage to selling both calls and puts. They tend to be slightly overpriced, so I prefer to sell them rather than to buy them. However, if there is a time when I'm looking at buying a call, we would use, I tend to use deep in the money calls that are very long dated and basically just give us an opportunity to buy that security out a couple of years. And when the risk reward dynamics are such or volatility is extremely high, we can just use put premium to buy that call. And it's a pretty nice little system. So we do that. We do that. Not all the time, by the way, but typically we're selling puts, by the way, since 2005, as long as there are contracts available on the security and the IRR is sufficient. I wouldn't buy stock in any other way. I wouldn't buy it outside the portfolio in any other way. Why would you not even if you really wanted it and things were so volatile, you just sell it in the money going out a week and you still get it for below the price on the stock exchange, which is such a huge advantage. So I always use this put selling. Every once in a while, there will be maybe a very conservative company where we just want to own a calls. It looks like it's going to run up a lot, and we might use it strategically.
So related, have you thought of using deep in the money call options to control the long positions? The questioner is saying that there's a very cheap implied interest rate, and you could get the added benefit of loss harvesting if the market tanks.
That is an interesting question. Added benefit of loss harvesting, meaning that people are going to sell when the market tanks and probably take their short-term capital loss. I'd be happy to talk to whoever it is. Maybe they can clarify a little bit or let me know, but outside of this call. So we haven't considered that exact strategy. And by the way, you can go pick up books on option strategies. There are going to be thousands or whatever of different permutations of ways you can combine these. We're actually using them for the most simple, in my view, the most simple and straightforward way. We are just reducing the price of entry. And the more complex you get, I think the more you run the risk of finding yourself. Part of the problem with options is there's always this time horizon. And if things are totally irrational in the marketplace, and your time runs out, you end up in a situation where you're either buying or not. So when you own calls, you always run the risk that at that point, when the call expires, the market's just tanked. So you lose your whole premium. So we haven't really considered that exact strategy. I understand that interest rates are very low, which adds considerable amount to that and reduces the overall price, but there's also high volatility. Anyway, I'd be happy to, maybe that's an offline sort of conversation that's had.
And then this question, I think, is referring to the long-term hedge that you've put together, but it may be slightly different. So he's asking, are you continuing to buy the deep out of the money puts on the portfolio or anything of that nature the way you've been doing over the past 2 years?
Great question, actually. Great question. I didn't address it in the slides because it was, I thought it might take too long, but we've actually, so the hedge is, so it's part of my mumbling. So the hedge, to bring everyone up to speed, has been put in place. It's a multi-year hedge that we built when volatility was extremely low over the last 3 years. And it actually worked all right, but it was a lot trickier and more work than I expected when it was working. So what did we do? We bought slightly out of the money puts, And then to help pay for those puts, we sold really far out of the money puts. And so we picked up, in fact, you know what? I do have another slide on this one. So I'll share it just to, oops, let me share this. And I'll see if it goes to the right slide this time. Nope. Interesting. You get to see all those appendix slides. So look, here's at the highest level what was happening. So you can see these numbers possibly. It's kind of along the x-axis here. It goes from 180, 190 all the way up to about 280, and that solid green line is the total payout. And this is like 10% of the S&P 500. So if the S&P 500 is at 280, and what is it today? Maybe three. It's like 3,100 or something. So if it fell below 280, we would start to receive a little bit of benefit from the put that we bought. And as it continues to basically go down, we see that solid green line spike. So what do we do? I'll just use some numbers. Let's say we bought a put for 20 bucks. Okay, so this protects us. And it lasts about 3 years. And then we would go down to a price of like 220 or so, and we'd sell a put, with maybe take that purple line or that red line going down. We would sell 2 puts, and we might pick up $15 for that. And we paired all that together and made this nice little basket where this combination developed over years and started to look like this big bold line. But the point is that it would cost us $5, and we were buying really, really cheap puts. So when volatility is low, puts are low. Volatility was very low, so we were able to put this on. When the market crashed with the speed that it did, and I wrote about this a lot in the report, so if you ever want to go back, and you can just go to that page and look over the years, we always talked about how this is a multi-year strategy. So these contracts expire each December 2020, December 2021, and December 2022. So when the market crashed, I believe it might have gone down to around 2,300 or so. We were in the right place, but we weren't near expiration. So what that means is the volatility of the put that we bought had gone up. So the $20 we bought had turned into, let's say, $80, which is, or $60, let's say. And the puts that we sold and picked up $15 for, those were going against us until expiration. So those also, let's say, rose to $60. So here we're in a situation where the hedge doesn't help us immediately, which we always knew. But then we were in a new situation where there was so much stimulus going on. It was such a different crisis where it was like designed by us. And then we didn't really quite know what was going to happen, but there's so much stimulus happening. And then the Fed started buying bonds. It just looked like it's very possible that things might recover. And so I didn't want to, I'm just sharing this story with you all. We didn't want to totally miss our opportunity. We had all these super valuable puts that we bought that were offset with the puts that we sold. So we actually did some really shrewd transactions during kind of Q2 where we unwound the puts that had gone, basically they net cost us $5 and they turned into maybe 40. So we got like 700% on some of that, but it left us super exposed on the downside. We had a 1 to 2 correlation. So as things fell, we would get paid on this one, we'd be able to buy this one, and then on the third one, we'd have to buy extra. And that would be an extraordinary situation, but it would be us buying at like 210 for the 2,100 for the S&P 500. So we put a bunch of money in the index. Typically, we wouldn't do that, but we'd be happy to do that at that kind of level. Ultimately, we needed to unwind those. So what we did is we took those 10 quarter puts that were now going out until December of 2022. We actually liquidated those as well and transferred them over into a basket of 12 securities that had a much shorter duration. We repurposed that exposure to 12 securities that had a 3-quarter expiration period. And so we're in that right now. And so we made money on the put as it went down. We lost money on those other puts because we unwound it early. Had we not done this, by the way, it would have been a total just net loss. It would have done zero for us. What we did is was some very shrewd maneuvers. We were able to put that downside exposure to about a dozen different companies. They're not necessarily they're great companies, but things that we're just going to do just fine and had been sold, and we're going to have cash flow. So in the basket, there's things like Disney's in there. And it's a big basket. So Disney's in there, and Starbucks is in there. And we just basically sold out of the money puts on some of these things that were really oversold with a 3-month, 3-quarter rather than 10-quarter duration. And as that's all unwinding, we're making a bit of money. I think we probably still have, those contracts still have quite a bit to go. Maybe we'll still gain a lot from those contracts over the coming, over the second half. Probably will add some decent high single-digit returns to the portfolio as well. Did I answer the question? You brought up the hedge, so I just went on that direction.
I'm going to say it counts.
Okay.
I think it could have gone one of many ways. So this one's a follow-up on something I asked earlier, which is, you mentioned that the portfolio was down in the beginning of the year and now it's gone back up. Can you give us the fund's year-to-date performance? How are we doing?
Yeah. We're still down a little bit. Look, I actually don't track on it. So sometimes people ask in the middle of the quarter, and it's a really strange question because it's like, well, we own Dondo and I don't have any information from Dondo yet. We own Talus and I don't have any information in Talus yet. So it's more like I have to estimate things, but because of this meeting and stuff, I actually took the time to figure it out. So I think, we're down. And then, by the way, things move every day. So I actually didn't look on Friday, if that makes a difference to anyone, but I think we're probably down 5-6% for the year. And that's fine. I really focus on the businesses, but I understand that it's people's money and savings. And of course we're growing that, but the most important thing is that the businesses are really growing. And so I think we're down probably 5 or 6%, somewhere in the mid single digits for the year. And we have a lot of the year left. So we'll see what happens. In fact, the strangest calls because there's so many LPs on here and I can just do it generically, I will tell you the strangest calls I get from people are like, hey, how are we doing? Or like, what's the performance? I'm like, we're not changing anything. Like Daily Journal does what it does based on the human participants in the market. So we can sort of check or tell you a number, but to be excited or disappointed over some sort of movement in price is not, it doesn't add any value. It's more just focusing on like a 2 or 3 year period and making sure we're going in the right directions and have our focus on great businesses. But yeah, I think so. We're down a little bit. Sorry, Danielle, I keep interrupting as you start to talk.
No, not at all. The LP who asked that question wanted me to tell you that he is super optimistic and a huge supporter. So very excited.
Great.
And then to follow up on your hedge strategy that you were talking about, would you do that hedge strategy again if volatility again starts to go flat the way it was pre-corona?
So throughout this entire process, kept a very detailed journal because it was such a, regarding the hedge specifically, because it was such a weird situation to be in. I know we can't time markets. I know people can't time markets very well. And suddenly I was in a situation that I had created where I had to start making market timing choices. And luckily I made the right market timing choices, but I recognized that prior to this, in a very rational mindset, I thought, well, if we go into a crisis, something like 2009 or something like 2000, or most crises, you don't get a snap. This was the fastest snapback in history, right? So you don't get this sort of combined government action from the Treasury, from Congress, from the Fed, just all at once. And so I'm not sure. In fact, in each letter, if anybody knows Ed Thorpe, I've sort of sent out to the world. I'd love to talk to him about this. He would be the expert that would know. He's the professor from MIT he ran a very successful fund that was based on a lot of these sort of sophisticated trading techniques. He would definitely have an opinion. I'd love to hear his thoughts. The jury's out on that at this point. It had markets gone down and stayed down, it would have been also really valuable. But I did not I started to say in a rational mindset, I thought, well, we could just wait through the end of December. But it became very obvious that we might not be able to hold on to this through the end of December and have it be worth anything. So for that reason alone, it starts to become less effective. I learned a lot through it. I don't want to ramble through this, but I'll probably write something up in the annual report about it. It's a good question. And I'm not sure yet. I do like having a hedge. I'm sorry, I will make one other point. Part of the reason we were putting that hedge on was also kind of where we were in the business cycle. So volatility was extraordinarily low. It was actually breaking records on the other side, being below 10 for so long. And so we were getting really, really cheap prices. We shouldn't be able to sort of hedge our portfolio 10% out of the money for $5, which is like a very, very low cost. So we did take advantage of that. Luckily, we did the timing right. I'm not sure how much of it was luck or skill. I don't know.
That's really thoughtful, and I'll look forward to reading more about that because I think it's an interesting case study. One quick question that just came in. What is the fund's current size, current value?
Oh, great question. Also in all the reports, we're still very small. So, we sort of operate like we're a $1 billion fund, but we are sub 10 million. We are growing. We probably, I think we're going to hit about 7 million soon, and we have about 2 million that's coming in right now. So I'd like to get over 10 or 15 million. My focus has never really been on raising capital, but raising capital is very important because it creates it for many reasons. So we can compound small amounts of capital into big numbers. And so probably I'm hoping that we hit the 10 million mark here pretty soon. And by the way, incidentally, we could put 10, 20 million to work very quickly during these times. So maybe we'll raise a bunch of capital.
So last question, which
Great.
maybe relates to
Last
what you just said.
It's good. Yeah, we'll close it up around 2 hours. We'll do last question.
With deploying large amounts of capital, what are your thoughts on the FANG companies? Facebook, Apple, Amazon, Netflix, Google. What do you think is going to happen with them? Are you interested in them?
Well, that's a great question. I'm very interested. I'm fascinated by them. I understand that they're very valuable. In some ways, they have, in many ways, actually, the FANG companies have pushed me to sort of understand what's going on in this space a little bit better. It would have been great to have some FANGs in the portfolio, but the issue with the FANGs is that to the value community, they never look cheap, but their business model is what's so exceptional. So they have a very capital light business model. And if you find a very capital light business model with a super long runway where you can redeploy cash flow that's coming in, you might actually have a better business than sort of a super capital intensive manufacturing company that has a big book value. And So the FANGs right now, look, Amazon's trading for what? First of all, I'll make a couple comments here because it's a good question. These firms now are all approaching kind of the $1-2 trillion range. These are the largest firms we've ever had in the world. Trees don't grow to the sky. The largest firms get beat out by other firms ultimately. But they're still super valuable and they're good companies. The whole market cap of the US is about 35 trillion. And the FANGs maybe make up 8 or 9 trillion of that. So can the FANGs double from here? I mean, they might be able to, but at some point they just can't possibly be the whole market. They're exciting. I watch them. If you had them at the beginning, congratulations. That's wonderful. You can keep them, but I don't think, I'm not like encouraging going out and liquidating your Amazon or something. But I think at some point they become big enough that their growth slows. They're also trading. Amazon, for example, I think I mentioned they're trading like 30 times earnings. So what that means is that earnings can sort of double. And then if they stop their growth, people might say, oh, well, maybe they should trade for 15 times earnings. And then that's today's price. So maybe the stock is a little bit ahead of itself in some of these. People talk a lot about Tesla, and Tesla's done very well. I don't know that the price is right. But it's one of those, you remember the diagram where we showed like a great business model and a great management and then the valuation. And they hit great business model and they hit great management, but the valuation is what stops us. And what a lot of the world has experienced over the last particularly 5-6 years is that the valuation and the price has continued to run. And so, yeah, it would be nice to have a price that's, sort of doubling every year for a few years. But right now, I kind of think they're fine. They're big. They're maybe on the expensive side, and so that's sort of my view on the FANGs.
Wonderful. Is there anything else to add, or should I go ahead and close the meeting?
Well, I think you can go ahead and close it. I'll just say to those of us that are left, first of all, thank you all very much for joining. It's a pleasure to have you all here. I do hope that you take a lot of this to heart. We are really, just go and look at the VIX. We are at a level of uncertainty in these markets that people alive have literally never experienced before. And long-term thinkers can recognize we're going to get beyond this period, and we'll look back at this moment as this extraordinary buying period, just the same way we see in 2009, just the same way we see in 2001, and you can keep going back crisis after crisis, and we are literally in that right now. So I really encourage you to put some capital to work. I think this is going to be known in the future. Maybe it's the great panic of 2020, but it's like the rarest and most remarkable opportunity, at least one of the rarest and most remarkable opportunities in our lifetime to put capital to work. And thank you all very much for being here.
Matthew, quick question from somebody. Will this meeting be available to view later? I see that we're recording it.
Yeah, we'll probably figure out something. We did record it, and so we may at some point put it up on YouTube. I will, with the caveat that the problem with putting it up on YouTube is that then nobody shows up next year because they don't want to just watch the YouTube version.
All right. So with that caveat, I would say go ahead and email Matthew if you want access to that or have any additional questions about puts or anything else. This concludes the Peterson Capital Management annual meeting. And thank you, Matthew, for being so candid and for answering so many different kinds of questions. It's been really fun to listen to. And with that, I'm going to let Matt, I think you are able to close the meeting.
Okay. And thank you very much, Danielle. I'm so pleased to have you on. And thank you everyone for joining. And we'll talk to you all soon.
Thanks, everybody.